welcome Peter Thornhill. Welcome to the Investor Motivation Podcast, and you are the author of Motivated Money. Welcome.
Thank you. Delighted to be here.
Peter, I thought we're rapt to have you here. I'll let you know that in our small little financial planning practice here that you are, by default, you've been our mentor, my mentor for the last 25 years, but you're by default the sixth advisor in the business here. Because as clients come in, we send them your video series, give them a copy of your book, which we religiously buy off you, and so you are sort of by default the sixth advisor in the business. So thank you,
wonderful.
Thank you for your efforts that you didn't know you were doing.
No, everybody deserves the best possible.
Yeah, absolutely. I thought I'd start off and just, I suppose, a bit of the background of how I was introduced to you, and that goes back to 2001. And you'll be interested to know that Amy and I found the video recording that came off a VHS and it was a financial wisdom or Commonwealth Bank conference on the Gold Coast, and so I'll send you a link of that, Peter. But yeah, it was 2001, and I was in a room with probably 200 or 300 people right at the back of the room, and you got into the depth of businesses, shares versus cash versus property, and I still clearly to this day remember the group of gentlemen in front of me that all of a sudden, once you started to say, property perhaps is not as good as investing into businesses, when their body language changed and they started to turn around and sort of looking for positive affirmation from me to say, yeah, I agree with you, property's great. I said, guys, I'm interested in this. If you're not, please rack off. And I suppose this is where I've been so lucky that I was probably mid-20s at the time, that I got exposure to the right person at the right time in my life, and in an industry that I've been in for 26 years, where everyone's out there to say, our product is great, we're different because, and you just come out with the simplest explanation of where to invest and why. It means there's so much that I just haven't had to spend my time understanding. So thank you for that, Peter, personally, for myself and my extended family. But I'd like to get some feedback from you, and I wanted to start with the punchline that after decades of implementing the strategies that you've been educating people about, financially, where has that landed you and your family, Peter?
What can I say, a position we would never in our wildest dreams have imagined. But the 18-year apprenticeship in the UK and getting out of the mess that is Australia in terms of finance and financial literacy was the best thing that ever happened to us, and it certainly has changed our lives in a very dramatic way, positively.
Fantastic. And you spent a certain amount of time in the UK, and I think our industry talks about balance funds and risk profiling, and which I personally think risk profiling is a very poor excuse for proper education about markets. So at what point did you sort of work out that this is all wrong?
It was a process of osmosis. As I say, the time spent in the industry in the UK was a real eye-opener for me. And coming back to Australia, the blunt difference just sort of went wham. Here's the bulk of the productive capital of this country locked up in bloody residential property, and the majority of Australian industry is owned by overseas investors, which means, and I think the figure for 2022, $40 billion in dividends disappeared to the investors who own Australia overseas. It's a damn disgrace, but you have to understand that unfortunately the parliament in this country is Australians.
Yes.
And I got the Register of Pecuniary Interest for the Federal Parliament, and discovered that the vast majority of the leaders of this country are up to their eyeballs in negatively geared property, and not many own shares in Australian companies, which to me speaks volumes about the contempt with which the leaders of this country treat the backbone of the nation.
So, Peter, that means that the leaders of our country, so from the layperson who doesn't know much about investing right to the top, still requires education about where to invest and why.
Absolutely, but it's very, very difficult because what I would describe as the financial mindset in Australia is locked in to property. And I'm sure you strike it as much as I do. You know, conversations about shares are all, bit risky. Apparently they all think that property isn't, but there are so many other elements associated with it, and there's no real attempt to improve the financial literacy of people in this country.
One of the things that stood out from when I did see you in Melbourne 2 years ago speak, Peter, was your comment around speculation versus investing, and I think that's something that Australia also has quite twisted and nearly the opposite way around to what it should be. Can you make that comment, sort of similar comment again, to educate our clients as to what speculating and investing, the difference really is there?
Well, there's one of the books on my shelf here in the library has got what I consider to be the finest definition of the word invest. The use of money productively so that a regular income is obtained. Therefore, you cannot invest in art, in Bitcoin, in whatever the hell you are speculating in. Speculation, the definition is buying and selling in an attempt to benefit from a fluctuation in the price, sometimes in an antisocial way. That's all you need to know.
And so ultimately when investing we're talking about, and I was watching a quick short on Warren Buffett, and he was commenting on Bitcoin, which you just mentioned, that ultimately we want to own business assets that provide products and services that people value and are happy to pay for. And if we do that over a long period of time, and those businesses continue to improve those products and services, revenue, profitability and valuations and dividends go up.
Yeah. The difficulty I have with Berkshire Hathaway, they don't pay dividends. And the only way you get any benefit out of owning Berkshire Hathaway is by selling and paying capital gains tax. So, I admire their investment skill, but at the end of the day, it's not my ideal model.
Yes. Yeah, we need income to spend.
Yes.
Yep. That asset-rich cash flow issue that will come up if you don't balance that.
And at 77 years of age, which I am now, that cash flow is the cornerstone of our lives. It enables my wife and I to do things together now at this stage that we would never have imagined in our wildest dreams. In fact, in 3 days' time, we go to Greece.
Fantastic. Peter, one thing that I've been watching my clients in recent times is around that psychology of investing and the emotions that come out. Probably not now because we've just had a very good 12 months in the market, but the preceding 18 months, 2 years where we're in a bear market, and I had my clients, hitting refresh, rebuilding their portfolios on their phones so they could get intraday prices, and going all the way back to 2001, where you were, making a comment about, what investors should be doing, what should they be focusing on, which is not relentlessly looking at their portfolios, as it serves no purpose. How did you tweet onto that so early that go and do something you like, stop hitting refresh?
Okay, again, it comes back to that apprenticeship in England and the listed investment companies, because I wouldn't touch an ETF with a barge pole, thank you. It's a trust structure, the ETF. It's the old managed fund that we used to mess around with decades ago. Yeah, they called it an ETF, and all of a sudden it became hot. The time in England, the listed investment companies have considerable flexibility. A trust structure must distribute 100% of its income and any realised capital gains at the end of every financial year. Bang. No questions asked. They cannot afford to retain it because there would be double taxation. A company does not have that problem. A company can invest in other companies and collect the dividends, and they then pay these dividends to their shareholders, but they can retain some of the dividends and utilise that for all sorts of technological innovation, etc., to enhance the growth in the portfolio and also the income stream. And to me, the model has been one that I still invest in as a result of my time in England. City of London, and it's a listed investment company. It's been going for 163 years.
Wow.
And my favourite chart is their dividends every year for the last 57 years. Where were you 57 years ago?
Oh, wasn't about at all.
Okay.
The double wasn't about.
Well, every year the dividend has increased for 57 years. What more do I need to know? And so it's this investment style, i.e. the listed investment company structure, rather than a trust or ETF structure, which gives flexibility to the fund manager so that during difficult times like COVID or whatever, where a lot of companies reduced or actually stopped paying the dividends because of the sheer uncertainty, which meant that the dividends that were being paid in those 1 or 2 years post-COVID dropped, but the listed investment companies had profits on their balance sheets and were able to smooth the dividends and keep them going onwards and upwards, which is all we need to know.
Because as humans, we just need X amount of money to live in our lives, and
Yep.
yeah. So getting back to that, obviously retaining dividends and the payout ratios, and this is the one thing that has always stuck with me over the last 25 years was, and I see it to this day, retired men coming in and say, Rob, I need high dividend yields and demanding high dividend yields. And I say, no, you don't. You need high quality businesses that potentially pay a lower dividends. And the comment, or the quote, which I relentlessly quote a lot of your comments, Peter, that you need a smaller dividend of a growing amount of money. Can you, I suppose, give us the background of that space and those words?
Rob, this is the yield trap. People think that chasing yield is going to improve their income. Yield is an abstract number derived from dividing an amount of income by the amount of the investment and multiplying by 100 over 1. Okay, and so they're looking for the highest yield, but that does not relate to the income. The yield is an abstract. The income are the dollars you've got in your hand. My best income producing investments are the lowest yielding. Couple of examples. CSL. Bought them when they floated years ago, and the yield has been consistently around 1%.
Yep.
But it's been 1% of something that has gone like that. So my 1% yield on my original investment of $110,000, my half-yearly dividend is $23,000. But based on the share price, the yield is still pathetically low.
And they retain a whole heap of the profit they make to further the business.
Correct.
Yeah. Just an interesting side note there, if you were there right at the start, Peter, it's, after the 3-for-1 split, it's 80 cents per share, I believe. It works out in capital growth to just under 40,000%. Congratulations.
Yeah. And, they're the good ones. Cochlear was another one. Got in at the float because I'd read the book about the guy that invented the bionic ear, etc. And that's done exactly the same thing. Absolutely boom. Very low yield. But as the dividends rise, the share prices rise. So you keep dividing one into the other and you keep getting a low yield. And it just frustrates the hell out of me that people chase yield. It's irrelevant. Look at the dividend history. Look at the cash payments, then consider.
Yes. And I remember, this is going back to the Gold Coast conference, I remember you had a graph of a certain company, it might have been Commonwealth Bank at the time, and it showed the value going up, and you were standing at the peak, and because people say, well, that's great, you enjoyed owning Cochlear and CSL over the last 30 years, but they've had their run, they can't get any bigger. I'd love your comments on that.
Well, I mean, they're two that by accident rather than design, I'm not the sharpest pencil in the box. I failed my last year at high school. It was that apprenticeship in England that actually lifted the level of understanding. But yeah, I just don't understand why people don't understand.
Yes. So, Peter, going to that apprenticeship, was there an individual over there that I suppose was my mentor, Peter Thornhill? Was there a chap over there that was just tuned in on where to invest and why, and the psychological side of it, in those times?
Well, there wasn't. There was one in particular, and he, I guess, took me under his wing, the CEO of Henderson Unit Trust Management in England that I worked for, and but again, it was just dealing with the fund managers and the way they operate in the UK, and the listed investment structure and so on. But yeah, there's not so much trading. Here, everyone's trying to make a buck, which is why negatively geared property, God forbid, is on top of everybody's mind, because they're just chasing the house price upwards. The fact that they're losing money and not having to pay tax on it, I think, well, I've never really thought of giving all my money away so I don't earn anything and I don't have to pay tax. But no, it is the attitude here in this country, and escaping from that for that period of time was pure gold.
Yes, yeah, different perspective and different overview of where to invest and why. So when we're chatting to people around Australia, which we're chatting to people all over the place, and we're seeing some very good property portfolios, great balance sheets, but the debt is extreme because they want debt because of the interest is tax deductible. And these people do say, well, I've done well. And obviously,
your response is compared to what?
Which is,
well, sorry, mine would be.
I'm just the puppet here, Peter. And I suppose, yeah, can you? And this is the part that as I said, why you're the sixth advisor in our business, because we use your charts to show our clients. But I suppose your overview of that, please, Peter.
Pete, the favourite thing is property for most Australians. Let's face it, this is where they're all looking. But I ask the questions, you receive rental income. Do you have any costs associated with owning that investment property? Yes, of course. They've got rates, repairs, they've got periods where people move out and there's no rent coming in, etc., etc. There's insurance, etc. When I buy shares, do I have to pay anything? Apart from buying the initial purchase, from the day I hold it, I pay nothing. Now, they get rent, all right? They try to get as little as possible so they don't have to pay tax. I get dividends. I get franking credits. I get tax credits. What do they get?
Headaches.
Headaches. But it's deeply ingrained. It is the Australian genetic defect.
Yeah.
This love affair with property. It just beggars the imagination.
What's interesting, apart from Peter Thornhill and a small group of your disciples, Peter, that who's going to tell the Australian public no, it's not a good idea? If you go to a real estate agent's buyer's agent, of course they're going to say yes. If you go to an accountant, they've got the depreciation and deduction blinkers on, they're going to say yes. Will the bank say yes? Of course the bank will say yes. Will the government say yes? Stamp duty. Who's going to tell them, no, there's better ways, there's less risk, there's more diversified ways?
Well, I guess it's, my disciples and me, rabbit, and trying to spread the message. But it is incredibly difficult because this love affair with property, as I say, is so deeply ingrained. Negatively geared property is a favourite. And I say, oh yeah, I borrow money to buy shares. Oh yeah, and do the dividends cover your interest on the loan? No. Oh well, you're an idiot. Apparently, if I negatively gear shares, I'm an idiot. If I negatively gear property, I am heroic.
You're a legend.
And as I say, I get the dividends, I get the franking credits, and I've had a lot of fun in the recent past because it annoys me that in this country there is no flexible rental property. I'm talking about leaseholds. If you go to a civilized country like Holland, England, Belgium, Germany, France, you can get long-term residential leaseholds. You have absolute security of tenure. In this country, it's 12 months and 60 days notice to quit. And unfortunately, my wife would not accept that, so we have to own an apartment. Now, we don't need a house any longer, and so we have an apartment. Now, it bugs me that I've got, $3.5, nearly $4 million sitting dead here. So I went to the bank, and this was a really, really interesting situation. I went to the bank and said, look, I'd like to take out a home loan. They've had all the title deeds to our properties over the years as we've moved around Australia, and it's been one bank for 50 years that I have banked with. I used to have a private banker, but they obviously don't consider I'm worthy of that anymore. But in fact, I don't think there's much left in staff anyway in banks anymore. And so I went in and said, look, I'd like a home loan. And he said, well, what are you going to do? I said, I'm going to invest the money. And he said, oh, you mean a line of credit? And I said, oh, no, because a line of credit, the interest is here. The home loan, the interest is here. So I want that one. Oh, yeah, but it's for investment. I said, it's a home loan. It's a home. It took me 3 days of solid before the bank finally had to admit that, yes, you're right, it is a home loan. So I was able to borrow at the home loan rate, which is fully tax deductible. to buy dividends, which cost me nothing to hold, and I get tax credits on top of that. The bank is lending me money, which is paying me more than I'm paying the bank.
And still to this day, Peter, if there is going to be, when there is a significant shock to the market, you'll be pinning the ears back and finding opportunities?
Absolutely. I mean, the COVID thing, the GFC, all of those were absolutely fantastic opportunity. To watch CBA go from $64 to $26, yes. Yeah.
I think.
In fact, I was on an interview once, sort of the closing. He said, "So Peter, what's on your wish list for the future?" And I said, "Oh, another global financial crisis, please." The poor guy went, "Peter, what do you mean?"
Yeah.
And I said, "Well, I'd like to go bargain hunting. Everyone else is selling. I feel it's my responsibility to pick up everything that they're selling."
These sellers need to sell to someone, don't they?
Correct.
Geez, you're a nice guy, Peter. Well done.
Yeah.
You're just looking after people. And I think, Amy, you found that exact quote yesterday, didn't
Yes,
you?
I did actually. I saw that one and I highlighted it, sent it to Rob and said, "This guy's amazing. He knows exactly what is right, really."
Yeah.
So, what stage in your career did you learn the psychology of investing? Because that's probably the bit that's most valuable to me now when I'm talking and educating my clients. Where did you get on top of that psychology and the emotional side of it, Peter?
Well, it was the process of osmosis, gradual absorption, and recognizing those people whose learnedness I could interpret and value and add to my library.
Yes.
And so it was just this long, slow process. The shock coming back to Australia was sufficient to get me alert. And then, from then on, they do it differently here to what we were doing in England. They're doing this differently, and so on. So it was just this gradual process over time. And being as tough as it is here has forced me to refine everything that I was doing, because in England it was just taken for granted. And
Yep.
and becoming an educator was never on my wish list. I was a reluctant public speaker. But in the end, in 2000, I finally left MLC because I could no longer, in all conscience, stand up and tell people to do things that I would never do anymore.
Right. Oh, gee, I saw you very early on in your speaking, educating career.
Yep. And I've got some old videos that were taken at the time, and in fact I was looking at one yesterday and I went, oh my God.
Well, the one thing there's so much that stands out that's still clear, 23, 24 years later for me, was, it was a room of financial advisors, and you were so brutal to say it's your responsibility to educate, to teach. And, I think you're a little bit, in the more retail world when you're chatting to retail investors, you're not quite as harsh, but you really let us have it. It's say you've got to teach people.
Well, over the decades, thousands of presentations, and I presented with all sorts of people, economists and the one thing that struck me, if you're going to present and you want to really drive a message home, you have to present with unshakable conviction.
Yep.
And and don't stand there and say, speak English for God's sake.
Now, one of the things that you were, really letting us know about was, the education piece, and it really, centered around a balance fund. I'd love your explanation for our listeners on that, please, Peter, because this is where the gold lies, of course.
The balanced fund is basically shares, property and cash, whether it's bonds or whatever. And so you have shares here looking like that, you have property here looking like that, and you have cash down here looking like that. So what we did, or what they did, you added the cash and the property to smooth the volatility and reduce the risk. The volatility is not a risk. The volatility is a function of liquidity and the fact that it revolves around the activity of people. They get scared, they all sell. The share market goes down. The value of the businesses didn't change. It was people's attitudes. So you have this utter madness, and the balanced fund was like the answer to everybody's problems. We're reducing the risk. And I've got some classic pieces of material, particularly from AMP. God, it's priceless. Now, the thing is that no one ever tells the client that over the next 30, 40 years, the balanced fund, so you've got shares plus a bit of property, plus a bit of cash, you're down here, right? No one ever tells the client that over the next 30, 40 years of their working life, they're going to be short $1.5 million. They never tell them the price they pay for the peace of mind that they've been sold. And it should be compulsory that here's the benchmark, shares. Oh, and by the way, industrials, no resources, because if I add resources to industrials, I end up down here. So no resources, and just good quality industrial dividend paying companies. But yeah, it's madness. This balanced portfolio I got over fairly quickly, and that's why I eventually left MLC, because I was not going to tell people to cripple their financial future by having all this garbage added to shares just to give them peace of mind. It would scare me. Yeah.
And it was at a key point that people see short-term volatility as a risk. But even if someone is retiring at 65, a couple are retiring both age 65, there's every chance one of them will get to 95. You're still 30-year investors. There's a lot to be done in 30 years.
Exactly, and that's precisely what is serving Frida and I well now, having no rubbish in there at all. It's all industrial shares basically, and yeah, we're having a jolly good time.
And the term diversification is often used in our industry, Peter. I'd love your quick take on that one. It's a loaded question.
Yeah, diversification.
So we take some of the good, some of the average, a heap of the bad, and we have a balanced fund, and you're now diversified.
That's right. You're now diversified. Yep. And like I say, no advisor would ever tell their client, their potential client, the opportunity cost they're going to pay in hundreds of thousands, possibly millions of dollars over the future, their future, by having added all this garbage.
So Peter, it'd be fair to say that if a balanced fund got you wild, the industry fund's life cycle investing strategy you'd be less of a fan of. As you got older, you hit 50, you go to from growth to balance, and then you hit 60, you go from balance to conservative, and so on. You'd love that?
I have got this classic advertisement from AMP, and it forms part of the core of my presentation. And it talks about this, you start off here and they have a lady and she's invested, and here's the portfolio, and it's shares, property, cash, blah, blah. As she goes through life, to reduce the risk, the portfolio is automatically rebalanced, so there's less shares, more rubbish, less shares, more rubbish, and when she reaches retirement, their comment is, she glides into a peaceful retirement. And my comment is, bloody hell, she just crash landed. It just knocks my socks off that, well, it doesn't surprise me anymore that AMP should run rubbish like this, where the rebalancing occurs automatically, and they're selling down the shares and buying more of the lead for the saddlebags.
And another one of your quotes, Peter, that if you're too conservative over your retirement at any stage of life, retirement is very long. If you're too conservative, you better die quick.
Yes. Yeah, because you're just going to become a burden on. You'll get the old age pension and blah blah, and you'll be claiming all sorts of government benefits, etc. So you just become a burden to the taxpayers. The trick is to become wealthy enough to be a taxpayer to help support those who really need help, but also to enable you to live a life that is worthwhile.
And what do you say to people that think that, in older age and as you approach retirement, if you have hit that critical mass where you've got that lump sum that is enough to last you until until life expectancy, until death, that what's the point of being invested any further because you've got that lump sum amount that will pay you enough just in interest as cash in the bank?
Well, I know that this won't help much because Australians can't spell it. Philanthropy?
Philanthropic endeavour.
Yeah, the ability to be able to support the art gallery, the whatever is your particular fancy, to provide all sorts of philanthropic support, and on final death, half the estate goes to this, half the estate goes here, etc., or the bits here, there, and the children I've educated, I hope, well enough, they will all are now financially independent, and they will be rewarded, as will the grandchildren, to a degree, but I want them to learn the value of hard work and devotion to duty, rather than, oh golly, I've just left high school and I've got this weekend job and I've just bought a new car. It's extraordinary. I'm obviously an old fart, I acknowledge that, and my background was one of you hardly ever dined out. My first car was 25 quid. I've never owned a new car. My current car is a 2005 Toyota Corolla, but I have enjoyed hiring Ferraris, E-Type Jaguars, etc. I rent the lifestyle. I don't want to own it.
Just there's massive opportunity cost in owning these assets, that you could be getting more dividends and long-term capital growth.
But I mean, I can see it. I have 5 granddaughters. So I can see it already with them. It's totally different lifestyle, totally different point of view in terms of finance.
Yes. With thinking about your grandchildren, my children are in that 20 to 25 bracket where they're first home buyers, as in they haven't bought yet, and the crazy property obsession of Australia has just pushed up prices based on what the banks will lend, and this thought that it always goes up. What's your thoughts about assisting children and grandchildren to, I suppose, to have that security of a home in Australia?
Yeah, if they can save up enough, they can afford to buy it. But I'm not going to buy it for them.
Yes.
And I'm not going to buy cars for them. I admit, with the family and the 5 granddaughters, etc., I'll treat them. So we all went to Iceland to spend Christmas at Santa's village, and to watch the girls sitting on Santa's lap walking through the snow and just being pulled in sleighs by reindeer. Yeah, okay. So we'll treat them, but at the end of the day, they have to then, if that's the lifestyle they want, they've got to fund it, and I hopefully will have taught them enough that they will be financially independent and not go crazy.
So you're happy to treat with more lifestyle experiences than the assets themselves.
Yeah, and the tough part is the the girls range from 20 down to 9, and their friends, to see 11-year-old girls walking around with painted nails, makeup, and I'm thinking, oh my God. But all that has to be paid for. So,
Peter, I'll remind you of another one of your quotes, and I think I'm not sure what the timeline is around this, but where a wealthy family bought their daughters their apartments, and the quote that you got was, don't steal your children's dreams.
no. The things that Frida and I achieved, and it was interesting background. Neither of us had a razoo when we first met. Frida's one of 10 children of a family that migrated to Australia in '54. I'm one of 4 children. My father was totally permanently incapacitated after the war. My mother raised 4 children, nursed my father. And so despite all these, background, Frida and I have done very well. But I think, again, getting out of this country was a major source of success.
Yes. Peter, in obviously you're still presenting, you're still working, but obviously in a semi-retirement capacity. So, just your comments on as you've reduced your work hours, I suppose purpose in life and in retirement. Can you just give us your observation of what that's been like for you, and that you're still enjoy having these chats and so on?
Yes, I do. But for Frida and I now, it's the career I've just been letting drift away. But for Frida and I now, it's time to have absolutely fabulous times in life. We both worked hard, we raised a wonderful family, and now it's our time to enjoy the fruits of our labours. So we were in Morocco in October last year. We were in Portugal in February this year. We're off to Greece. We're looking at the next one. But I will say one thing. The world's population is becoming too big. Visiting some of these places, to have a queue to look at a site of interest, to have a queue half a kilometre long, to have station platforms that you've got to wait outside before the train gets enough people off that they can let more people. The overcrowding is just becoming extraordinary.
Yep. And one thing that I've probably learnt in recent times, that I'm very, like you, very grateful for the opportunity that have invested in a way that's provided financial independence many years ago. Don't have to work, but like you, it's something that we enjoy. And as I've been able to travel, I've sort of worked out that overseas travel can be, very grateful, but can be stressful, can be busy, can be tiring in airports and customs. That sometimes the coffee down the street with friends, or taking your whole family out, say, Frida and I are paying, by the way, let's go and enjoy some time together. Some of that stuff, the 90% of the year is just as fun and just as important.
Yes, and it's often easier to have a nice holiday here. So we find a nice a lovely house somewhere, big enough to take the whole family, and we head off there. It's above a beach, and we all have a wonderful time. Yeah.
Yeah. I found that when I mentioned to my children, say, hey kids, we're thinking about going skiing on this weekend. Who's interested? They all seem to turn up because, you know, if Dad's paying, it's and I want them there. So I'm a little bit conflicted on this. That's building the memories and enjoying the fruits of, you know, decades of investing and decades of hard work.
I don't know. Well, I guess my upbringing had a huge influence on the way our lives turned out. And I guess the same thing's going to happen with our children. Their lives eventually will, the foreshadow is the way they were brought up. And there's an interesting observation I would like to make. When we were still in England, all the boys were born in England, and when the first child came along, Frida gave up work, and she then devoted her time to raising those boys. So the home life was outstanding. And I have 3 highly emotionally intelligent young men now. I look at what's happening now with couples. They're both working in this chase for money, and they get to see the kids maybe at breakfast, maybe at dinner. There's often a lot of childcare involved. So the disconnect I find scary.
Yes. And I suppose that chase for money that you mentioned, Peter, is not particularly for some about wealth creation. It's just trying to maintain their home loans because the debt, you know, I think the average debt in Australia is over 600,000 now. It's just such a big number to maintain, and that's what worries me. That yes, husband and wives have to work. It's not a choice.
No.
And yeah.
But our expectations in Australia are high. You know, you have a family of parents and maybe 1 or 2 children. Why do you have a 4-bedroomed house or a 5-bedroomed house? Why do you keep adding on, building more, larger, and so on? You know, when I realised that we weren't coming back from England in a hurry, because we originally were going to have an 18-month working holiday. It turned into 18 years. But when we realised we were going to stay, we bought a tiny little terraced house in Clapham, just off the north side of the Common. The grandiose designs we have here, why can't we build more terraced housing instead of having these massive estates that are spreading further and further? The other thing I find interesting, these estates now, the real estate developers are very clever. The gap between the houses, so there's a fence, is if you leant out the bathroom window, you could touch the fence of the next door neighbour.
Yep.
So you've got cheek by jowl. Where are the trees? Where's the grass?
Clear for real estate.
And it just... And why do they build houses with black tin roofs?
Yeah, it doesn't sound efficient. When I was, I did some training in Thailand last year. It was when I was on social media, and I saw the very clever marketing exploits of the property spruikers, and I couldn't help myself, and I sent a few screenshots through to Peter via email, where the property spruikers are saying, the government endorsed strategy where you can use your tax dollars to buy property, and everything is tax orientated, and I said, the question I had for Peter was, how on earth can they do this? Our industry, financial advice, is so highly regulated, but there is zero regulation there. You go buy an $800,000 house with, low deposit or no deposit, no diversification, debt to the eyeballs. This is nuts. How can they do it where we'll be dragged over the coals for taking such risk in the share market? But your response was, I suppose, back to that early discussion about our politicians.
Yeah.
They're all invested. They've all got to the eyeballs as well.
Yes. Yeah. It's a tragic, as I say, a genetic defect in this country, and it has a huge impact. All our productive enterprise is owned by overseas investors. BHP, the big Australia, bollocks. It's 86% owned by overseas. So it's not an Australian company. And Woodside and all the others, they're all in Rio, they're all in exactly the same position.
Peter, you might be interested to know, I did a search on foreign ownership of Australian companies last week. Guess which company Australians actually own the majority of? Telstra. High dividend yield. Thought you'd appreciate that.
Oh dear. And two of the world-beating companies in this country, CSL and Cochlear, most of their shares are owned overseas.
Probably a question that sparks to mind now, Peter. You mentioned that you only would like to own industrial businesses that do pay out a dividend. Was there ever a point where, or is there a minimum payout ratio that you would see? We don't look at the yield, but how do you assess what a minimum kind of dividend paying business might be?
No idea.
You do look
I look at the history. Yeah, I'm just looking at the history, and this is why I am now winding down my direct shareholdings. I've successfully reduced our super fund from 54 shares to 8. And I continue to unwind the direct shareholdings. It's all going into the listed investment companies. The like of Whitefield I like a lot because it's 100% industrials, brickworks, and so on. So it's going in to more and more into the listed investment companies, and just tidying the whole thing up. If anything happens to me, my wife doesn't inherit a huge splash of shares. She will inherit a handful of listed investment companies that will continue to provide on an ongoing basis an increasing cash flow.
And that allows you, with less administration or care, to focus on what really matters to you.
Yes, family, friends. I was going to say career, but that was back when I was working. No longer. Family, friends, and having fun.
Wonderful. Peter, probably backtracking a little bit, obviously resources are not your bag. Can you just give your explanation as to why you don't muck around with resources?
Digging stuff out of the ground is a mug's game. I think the figures are, we used to make cars in Australia. I don't know whether you remember. Holdens at Fisherman's Bend in Melbourne. Ford in Broadmeadows in Melbourne. Do we make cars? No, we don't make anything. We add no value. We dig raw material out of the ground. We ship the iron ore off at, say, $250 a tonne to Asian nations, etc. And we re-import it in the shape of automobiles at $20,000 a tonne.
Yep.
I mean, duh.
Yeah, so these are the businesses that are making the products that we buy back.
Yeah, so we make nothing.
Yes.
All we do is sell the raw material.
Yep. And then plough some of the wages that people earn into property that doesn't produce anything.
Yeah. And funnily enough, we have a lot of natural gas, but we don't have enough to satisfy demand, so we're importing natural gas. I mean, what? And we're not making any attempt to shift away from that. And the corporates obviously make a huge impression on Parliament. And so, they're going to allow the gas companies to go on and and produce more and so on. I saw this wonderful thing. We were in Spain a couple of years ago, driving from the north to the south, and about halfway down, on a clear sunny day, I glanced, and on the near horizon, blue sky, cloudless. There's an aura on the horizon. I think, bloody hell, you know, like you get an aurora at night over a city, you have the sky, yeah. Anyway, we stopped halfway down, and I asked one of the locals what it was, and he said, "Oh, that's Noor 3." What? Noor 3. So this is Spain. Has got this tower surrounded by mirrors, and at the top of the tower is a tub. The concentrated energy of the sun melts the salt. The molten salt is then used to produce steam which drives an electric turbine. There's not a piece of smoke, there's no ash, there's no nothing. And these things pump out. They're in Morocco, they're in Spain. We looked at it in, I think they built one in Adelaide. No. Gas, coal, yeah.
Too much.
And here we could, with all the blank space in the centre of Australia, totally unproductive desert, we could have massive solar farms producing electricity, and there's not one bit of useless output. No ash, no smoke, no steam, no nothing.
Amy, as a 26-year-old, so a different generation to Peter, to myself.
Yeah, throw it at me.
Yeah, I'll throw you under the bus. I suppose. What's your question in relation to investing for your future?
Well, I think it's interesting, Peter, that as you are growing older and kind of thinking about you simplifying your estate and matters down the track, that you are reducing your direct shareholdings and increasing your listed investment company ownership. Do you think, having your time over again, that you would have started out directly into the listed investment companies rather than cherry picking direct shares?
Tick the box. Luckily, I have done that with my 3 sons, so they don't have massive shareholdings. They don't have to sit and look at the screens and they're investing in the listed investment companies, which takes all the financial hassle out of the way and allows them to get on with what's important: family, friends, career.
Thank you. Anything else from a 26-year-old, Amy?
I highly agree that we are, as a generation, very focused on lifestyle, and whether that's because of the social media and the fact that we only see the highlights of everybody's lifestyles, that makes us think that the house needs to be the biggest and the best just to be in the background of a photo or whatever it might be. But how do you try and train your grandkids and your children to not chase that lifestyle and put their feet back on the ground a little bit?
I am not a preacher as far as my family is concerned. They have their lives to live. I provide common sense if it's invited, and when the granddaughters come here to have a sleepover or whatever, the phone goes in the cupboard, because otherwise I have granddaughters on the couch all day. It's tragic. It's tragic. And you know, the relationships between children now is a totally different kettle of fish. Because when I was young, there wasn't any bloody television in the early years. And you got home from school, you dropped your school bag, got on my bike, cycled round. Oh, Owen's not home. I'll go and see if Kerry's home. I'll go and see. You just chased your life with your friends. And you made a kite and you went and flew the kite, or you whatever.
I hope when you do have the granddaughters around, Peter, that you put their phones away and you read them a bedtime story.
I've got to be careful. I want to maintain a good relationship.
I will shamelessly plug your book as we always do, and when we're chatting to people, I often get that question, Rob, what book would you recommend you read? And that's the book that I recommend they read, because it means that I don't need to understand every resources business out there. I don't need to look at property. I don't want to understand the craziness of negative gearing and putting tax before investment, which Australians seem to do. I don't need to worry about crypto. I know where to invest and why. And thank you for that.
Yeah, getting rid of that responsibility of managing the finances out of your hands and into other hands that know exactly what they're doing and just will continue, as the City of London's done for 163 years. 57 years of unbroken increasing. Have you had every year an increase in your salary?
Well, a little bit. it stays taken for
a little bit. Okay. And when you quit work, what are you going to do? So I can sit in retirement and have a growing income stream, which is exactly what we appreciate and enjoy to the max in the final pegs of our existence.
You've got a lot of time left, Peter, a lot of energy there. Peter, thank you so much for your time. I was like a kid about to go to the Horsham show. I was a bit excited.
Because he texted me last night and said, I don't know if I'm going to be able to sleep tonight. So.
I am a fanboy, but if people wonder why is a middle-aged man like Rob, so you're hanging off the words that you've spoken over many years. It's because I just know that in a world full of noise of we're better or invest over here and all the conflicts, that you've been a highly cynical person, but clearly an emotionally intelligent person to understand the psychology of humans and investing, and this is the stuff that's just not taught enough in our industry.
No, correct. And I'm hoping Ollie he will step into my shoes, so it won't go away.
Keep spreading that common sense.
Good. Thank you very much, Peter Thornhill. If people want to reach out, you have your newsletter that you write when you've got the creative energy and something to say, and that's at Motivated Money, so people can subscribe there. The book is also called Motivated Money, and it's a complete coincidence that our podcast is called Investor Motivation. Complete coincidence. Thank you, Peter.
No, thank you. And Amy, wonderful.
It's been a pleasure.
Enjoy Greece.
Oh, don't worry.
And the Ferrari that you're driving.
No, we'll just take whatever's. It's a guided tour with archaeologists, so there'll be quite a lot of ancients.
Fantastic. All right. Yeah. Take care. All the best, and travel safely. And we will see you at one of your sessions soon, Peter.
Okay. Thank you.
See ya. Bye bye.